Within the high-yield income investing realm, easily one of the most discussed investment providers that exist has been YieldMax. Since their founding less than 2 years ago, this company has already launched 20 ETFs over the course of just 14 months. Their exchange-traded funds have been popular among some investors who are seeking high income, particularly for their eye-popping dividend yields. The majority of their funds currently have dividend yields that exceed 20%, with some yielding much more than that. Their most popular ETF in terms of assets under management, TSLY, has at times offered a dividend yield that exceeds 70%, which obviously has been a big draw for people seeking income. I've also covered and gone in-depth on a handful of their funds, including TSLY, NVDY, and CONY. All of their ETFs use the exact distinct covered call strategy, which is often referred to as the poor man's covered call tactic. This unique strategy that isn't used by other covered call ETFs is known to come with some serious downside risks and can wreak havoc on the share price of their ETFs. Last week, YieldMax issued a press release regarding one of their ETFs, which I think implies just how poor their funds can be in terms of being a long-term holding. And I think all shareholders and people who are considering their funds should be made well aware of what's going on. On February 13th, YieldMax announced that TSLY would be going through a 1-for-2 reverse split. According to the press release, YieldMax ETFs today announced that the Board of Trustees of the Title Trust II have approved a 1-for-2 reverse split of the YieldMax TSLY Option Income Strategy ETF. The reverse split, which doesn't require investor approval, will go into effect on February 26th prior to market open. A reverse split is when a publicly traded company, or in this case an ETF, reduces the number of its outstanding shares. A reverse split decreases the number of outstanding shares that exist and proportionally increases the price per share of those outstanding shares that do still exist. The press release shows an example of what happens during a typical 1-for-2 reverse split. If you own 200 shares of an ETF that's currently trading for $10 per share before the split, you'll only have 100 shares after the split, but the share price will increase to $20 per share. Through this process, your investment total will not decrease, and you can see that the dividend amount will also increase in proportion to the reverse split. This kind of tactic lately has been used with some mortgage real estate investment trusts, including the larger player Annaly Capital, as well as another company in this field by the name of Orchid Island Capital. So why do companies or ETFs perform reverse splits? There's really only one reason a stock or a fund would perform this, which is to increase their share price. When it comes to stocks and diversified funds like ETFs or even closed-end funds, some financial institutions that perform equity research will not cover a security if it's trading below a certain amount. For most of these firms, they won't provide coverage for a holding that's trading for less than $10 per share, although it could be $5 for some companies. Being covered by these equity research firms is important because not only does it provide publicity for their investment, but more importantly, people in the financial realm, including mutual fund and pension managers, won't even consider buying an investment that's not covered. So to ensure their investment stays above a certain share price, a company will perform one of these reverse splits. But the move in doing this is purely cosmetic. It doesn't fundamentally change anything besides the share price and the dividend amount, which again is changed in proportion and doesn't result in investors losing any money. However, there is another reason why companies will do these reverse splits. The fact that YieldMax is now starting to do these with their funds highlights that their ETFs have a rudimentary problem. YieldMax uses a covered call strategy on their ETFs, but it's not like the covered call funds offered by Global X, JP Morgan, or Neos. As I've pointed out in the past, the prospectus for each of their funds provides a good explanation on how their covered call strategy differs from other covered call funds out there. It says the fund will implement a synthetic covered call, which they describe as similar to being a traditional covered call strategy in that the investor sells a call option that is based on the value of the underlying security. But in a synthetic covered call strategy, the investor does not own the underlying security, but rather seeks to synthetically replicate 100% of the price movements of the underlying security through the use of various investing instruments. The strategy YieldMax uses for their funds is a lot more complicated than other types of covered call funds. Through owning Tesla stock indirectly through a synthetic option, which is acquired by purchasing a call option and then also selling a put option at the exact same strike price, the fund will additionally sell another set of calls that are 5 to 15% out of the money and have an expiration date of 1 month. If we look and see what's inside this fund, you'll see it's mostly made up of US Treasuries. This is where the fund has basically parked their money in order to use its synthetic strategy. All of the YieldMax funds hold treasuries, and because interest rates are so high right now, they are offering good yields, but nowhere near the 50 or 75% yield some of their ETFs are currently offering. So what are the results of this strategy? What we've seen with YieldMax's ETFs is that when times are great for the underlying stock, they're usually moderately good for the YieldMax fund. But when times are bad, they're actually much worse for the YieldMax fund on average. If we compare Tesla stock with the Tesla Covered Call Fund, their one-year share price performance has been pretty revealing. From this time a year ago, TSLY is down roughly 3%, but the YieldMax ETF is down almost 46% during this exact same time. If you were wondering, the high dividend payments do make up for some of the collapsing share price, but ultimately the total return for TSLY has still been worse than for Tesla stock. The quick downturn of TSLY shows that the covered call strategy it uses isn't sustainable, especially for stocks that have a high amount of volatility. When times are good, they'll be stunted for these funds so they aren't able to recover much after suffering serious losses. This is the YieldMax Coinbase ETF compared to the actual Coinbase stock. Over the course of a month, COIN is up 26%, but CONY is only up 7%. And on days where the share price of Coinbase increased rapidly, CONY could only grow by a tiny amount. I'm mostly singling out TSLY here in this video because Tesla has been one of the worst performers this year that has a YieldMax fund. But this kind of trouble can and likely will happen to every YieldMax fund ETF eventually. The dividend distributions for TSLY have also been decreasing ever since it came out. So the idea that these large dividends will be able to pick up some of the slack in share price growth isn't going to fare out too well. The tech sector, which is what a lot of YieldMax funds invest in, has been doing really well over the last year. But eventually, when another bubble does pop, I expect their share prices to fall pretty sharply. I also expect that all of these YieldMax funds will eventually go through these kind of reverse stock splits, and potentially many times over the course of their lifetimes. By performing these splits, these ETFs will continue to just keep falling in share price and dividends perpetually over time. I can think of a company that's done this before to an extreme, which is Armor Residential. Their stock over time has just kept falling to where it's currently down almost 95% since its IPO. According to Google, it says their stock was trading at $363 per share back in 2007, but this isn't actually true. Armor Residential has actually done some extreme reverse splits to ensure that their stock hasn't gone down too far in share price. In 2015, they did a 1-for-8 reverse split, which was intense. Just last October, they had another reverse split that was a 1-for-5. And ever since then, their stock has kept falling in share price. The only reason they haven't become a penny stock is because they've done all of these splits, and I'm concerned this will happen to TSLY if you give it enough time. In my previous videos, I have said that the YieldMax ETFs can be good investments, but only during specific periods and not as long-term holdings. To give an example, there's no denying that their NVIDIA covered call fund, NVDY, has been a great investment since being launched last May. However, your experience largely depends on you timing the market correctly. You have to know when to sell out of this fund, which I wouldn't recommend trying to do this. If you couldn't tell at this point, I'm not convinced that these YieldMax funds are worth the dividend yields they offer. Now that TSLY has started doing these reverse splits, I think it's going to keep happening as time goes on. I think that based on what we've looked at, it shows that these aren't good long-term holdings that someone can retire off of. There's plenty of holdings out there that can provide stable yields of 8% and even 10% or more on occasions, which I talk about on this channel, but trying to reach for a 75% yield I think is just way too risky. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.